Futures higher after a tumultuous week. 30 minutes until the start of trading. I'm Matt Miller.
And I'm Sonali Basak. Katie Greifeld is off today, and Bloomberg Open Interest starts right now.
All right, looks like stocks kick off this week calmer as investors await key data which will shed light on the health of the U.S. economy and inflation and help us divine an outlook for the Fed. Meanwhile, Fed Governor Mickey Bowman warns inflation still faces upside risks, signaling that she may not be ready to support easing next month. And on the corporate front, Starboard reportedly takes a stake in Starbucks as Disney unveils expansion plans, including a new area devoted to the bad guys in movies. Let's take a look at where markets are trading right now. In terms of futures, we do see gains on the S&P and the Nasdaq, about 0.2%. We clawed back all of the ground that we lost on Monday last week and ended unchanged on the S&P. The 10-year yield right now at 3.95, inching ever closer to the 2-year, which, Nolly, I believe is about 4.06 right now. You have me on 2-year watch.
Last year was really the move higher, but yeah, let's see what this week brings, especially with that CPI print. Those individual movers we're keeping an eye on this morning, Matt. We're looking at NVIDIA really rising about 1.3%. It is moving the most by value this morning ahead of the open. Starbucks also rising on that report of a new activist investor taking a stake in the coffee chain. Starbucks up about 2.5% this morning. That is Starboard value ahead of Elliott now. Both big investors in that coffee chain. KeyCorp, keeping an eye on it, up more than 17%, absolutely surging here. Scotiabank agreed to take a 15% stake in KeyCorp. Matt, we'll keep an eye on the rest of the financials as well.
Yeah, absolutely watching. A lot going on in terms of the Wall Street beat, so you want to stay tuned for that. And then in terms of economics, we get some big inflation numbers out. Here with a preview of the week to come is Bloomberg's Michael McKee. And Mike, you know, investors are more wary of each data point as we see how much volatility they can provide.
Yes, and I think this week is going to be a bit of a surprise, not in the numbers, because we're pretty good at forecasting CPI and PPI. I think we'll see continued declines. Those come tomorrow and Wednesday CPI, and that's going to get a lot of attention because of the Fed. We are expecting slight declines there, though. So I'm looking at retail sales as the number of the week, at least for Wall Street, because it will fit into the narrative of the economy slowing down. Is it slowing down too much? That's going to be the question that people ask. Now, here's the CPI and PPI forecast. As you can see, very slight changes on a year-over-year basis, but continued further progress towards the Fed's goal of 2%, and just keeps us on track for perhaps a September rate cut. Not going to influence folks on the street as much. It's the retail sales forecast is going to be a little bit weird this time because we had the cyber cyber hack for auto dealers in June, and that pushed down overall numbers. Now we're expecting a fairly decent rise in the headline numbers because car sales will be up. They'll have a rebound, but we're not sure about the rest of retail sales, even though we had Prime Day, et cetera, in July. There's questions about seasonals for the month. So will we see Wall Street think that we have a problem, or will we see Wall Street think we're on track for a move? And I was thinking, when you were talking about the Disney expanding, they could put in a Wall Street roller coaster ride.
Yeah, speaking of bad guys.
And make lots of big money on that.
I was thinking about your Deadpool reference over the weekend as well. The villains have a space in life. You know, how much room for volatility is there in the bond market this week? Because we have a lot of data, to your point. Just last week alone, we saw the 10-year move from under 3.8% to flirting with 4%, now a little bit under that. Still at least 100 basis points of rate cuts baked in this week. What are you expecting in terms of moves?
Yeah, I don't think we see a lot of moves, at least until the end of the week, if then we don't have auctions this week. So we do have the inflation numbers, but not moving all that much. So in theory, those will be priced. Then the question is, will people react to retail sales? And then on Friday, the consumer sentiment numbers, if those come in significantly up or significantly down, that could also force people to rethink what the Fed is going to do.
Mike, we thank you so much. We're looking forward to your coverage all week long. That is Bloomberg's Michael McKee. Let's get into market expectations for the week with BMO Wealth Management Chief Investment Officer Youngyu Ma. You think about what Michael was saying about this week, the volatility you could expect is after the tremendous volatility we saw last week. What do you expect out of both the inflation numbers this week as well as the retail numbers?
Yeah, it has been quite a roller coaster ride, as was mentioned. We think the inflation numbers will probably come in favorably, but if there is a surprise, which we don't completely rule out, that could certainly move the markets one way or another. Hopefully that surprise would be on the favorable side. Retail sales, I think, are going to continue to show somewhat of a bifurcated consumer. On the middle and upper end of the consumer spectrum, I think that's still very healthy. On the lower middle part and lower part of the consumer socioeconomic spectrum, they still continue to face strains and challenges with spending and budgets and the effects of inflation. So I think how that plays out in retail sales overall could be a little bit on the soft side. I don't think that's deterministic for the economy, but it could give the Fed some additional ammunition or impetus for rate cuts in September.
In terms of those rate cuts, Youngyu, I think you have an interesting take on the long and variable lags. Are they going to be shorter on the way down than they were on the way up?
I think the idea of long and variable lags is a rule of thumb, but of course, given the situation, the impact can be sooner or later, depending on what's happening in the economy. And I think the reason that we didn't see a very large impact from the rate hikes that took place, or it took a long time for that impact to set in, is the same reason that we'll see a quicker impact from rate cuts. I think there's a lot of pent-up demand by corporations that are looking to either roll over debt or borrow money or expand, that have been waiting for lower interest rates to do so. At the same time that we get rate cuts, or around the same time toward the end of the year, as this is rolling out and getting further rate cuts, we'll also see resolution about the election. And so I think this confluence of factors is going to come together with both lower interest rates, less uncertainty in the markets, less political uncertainty, and should have a greater effect on the economy. And that long and variable lag will probably be considerably shortened as we get rate cuts. And by the time we're just a few cuts or maybe 100 basis points or so into it, we'll start to see more of an effect.
Even if you believe you're going to get that first rate cut in September, that is more than a month away until we have that Fed meeting. And when you talk about the retail sales data, the bifurcation in the consumer, we've been talking about that bifurcation for a while. When does that bifurcation just bring more people into that pain spot here? How much pain between now to September to those long and variable lags do you expect to start rolling into the consumer that could then start rolling into the market?
Yeah, that's a good question. Is there a tipping point where we really start to drag down the economy? We don't think we're at risk of that, or at least not at serious risk of that. And Fed interest rate cuts would go a long way to reduce that risk even further. We think the underlying fundamentals remain healthy. We see that in the weekly initial unemployment claims. We see that in ISM services. We just don't see a lot of downward momentum in the economy. And it would be that momentum that would really start to have a binding effect and a greater downturn in terms of spending. So we feel pretty good about where the fundamentals are right now. And could it take place? Yes, we could get that kind of downward spiral in the economy, but we think that would only take place if we didn't have rate cuts until well into next year. We think rate cuts in September, November, December would really go a long way toward shifting that dynamic and alleviating some of the pressures we see now.
We've heard lately a lot about a value play post election or post, vote in November. In fact, the last 11 elections, you've seen value stocks outperform growth for the first 6 months, post the vote. You like industrials. Do you think those two are kind of tied together here?
We think they could be tied together in terms of that value play, a bit of rotation from what has been a long run for large cap technology stocks or mega cap technology stocks into more value, even into small caps, but also industrials as well. Industrials on average tend to be more in the mid cap space. There's some large ones, some smaller ones, but we think that there is pent up demand. There are a lot of projects that will be, although they may have been pushed out a bit, they're still in the works. And there's a lot of spending that still is going to roll out in the industrial sector. And we think once the uncertainty of the election gets behind us, a lot of those trends that have become a bit cloudy will become a lot clearer. And those industrial names still stand to benefit from both spending trends, onshoring trends, and expansion and things like data centers. We think there's a lot of runway there to go.
What are the trends you're catching out of this earnings season, Young Yu? You think about the fact that we're almost there, but you also have some massive names. Walmart this week, you have Nvidia at the end of the month. What are you still looking out for?
Yeah, it has been an interesting earnings season. One thing that has been noteworthy is that the beats by companies have not been quite as strong as in prior earnings seasons. And I think that's also given the market a bit of hesitation in terms of building momentum, or perhaps concern that there could be a flip in momentum to the downside. We're looking just for stability. We're looking for stability out of these big names. We're looking for signs of AI being rolled out further among companies and actually seeing those use cases turn into beginning or early signs of efficiency and productivity. We think that's very important because ultimately, whether companies such as Nvidia can continue to do well will be dependent on the spending that takes place broadly across the economy for AI. And that's really ultimately going to be dependent on productivity gains, efficiency gains, really starting to kick in. And we think that that's a 2025 story, but it's nice to see early signs of that when they appear. So those are some of the things we're looking for in terms of anecdotal information at this point. We think would be hard data in the coming quarters.
BMO Wealth Management Chief Investment Officer Young Yu Ma, thank you for joining us on this Monday, a calm Monday. Finally, another quick check here on futures. We're taking a look at those S&P futures, up still about 0.2%. Same goes for the NASDAQ 100.
So chill.
So chill out there. But the Russell 2000, pretty much flat, no bid in the small caps, really. Big change from what we saw just about a month ago. We're going to take a look at some of the stocks moving ahead of the opening bell. Here's Abigail Doolittle.
And not so chill. Take a look at the shares of B. Riley, absolutely plunging, down about 48%. The financial firm essentially pre-announced to the downside. They're now saying that they are projecting a loss. They've also suspended their dividend, and they are facing a U.S. probe over risk disclosures. Not everybody's surprised by this. There is a stunning 71% bearish short interest on this stock. Those bears really in action today. Let's take a look at another area that's under some pressure, and this, of course, is the crypto stock space. We do have Bitcoin and Ether up a little bit today, but Marathon Digital Holdings and Coinbase Global both lower. I believe that the source of this pain, probably the volatility in crypto, those crypto coins, but Marathon Digital also proposing a $250 million private placement. Some folks, probably investors, not pleased by the idea of that dilution. Let's end on a bright spot, though, Matt, and this is Monday.com. These shares right now at pre-market session highs, up 10.3%. The discount retailer put up a nearly 67% earnings beat. They beat sales by about 3%. There is a 6% bearish short interest, so some of this could be a squeeze. But this retailer, it's one area, this continued mixed picture that we have for consumers, but discount retailer doing well.
All right, Abigail, thanks very much. Abigail Doolittle looking at some of the stocks moving for us on this Monday morning. Coming up, Starbucks is already contending with activist investor Elliott Management. Now another activist, Starboard Value, has reportedly taken its own stake in the coffee chain. Details next. This is Bloomberg. Let's get now to high interest to look at what's making headlines around the world. RBC's former CFO said she had the chance to become the first woman to run the bank before she was fired over a personal relationship with a colleague, or allegations thereof. That's according to a lawsuit she filed against the lender. Both she and the colleague were fired, and both have fired separate legal actions for wrongful dismissals, asking for tens of millions of dollars in pay and damages. The UK's Prime Minister is still locked in an ongoing disagreement with Tesla CEO and the billionaire owner of X, Elon Musk. Musk suggested the UK was punishing thought crimes by arresting people for online posts linked to riots in the country. The Prime Minister's office said it disagrees completely with Elon Musk. And foreign investors pulled a record amount of money from China last quarter, reflecting pessimism about the world's second largest economy. If the decline continues for the rest of the year, it would be the first annual net outflow since at least 1990. Sonali?
Now let's take a look at Starbucks pre-market. Shares are gaining on a report, let's say unconfirmed here, by the Wall Street Journal that activist investor Starboard Value has taken an undisclosed stake in the company. Shares are up about 2.3% pre-market. Starbucks has been struggling with the slowdown in demand, as well as pressure from, remember, another activist here, Elliott Management, which is one of course, the most feared activists out there. We're going to discuss it all with Bloomberg's Crystal C about what is going on at Starbucks. Of course, a battle with the company and activist investors. Its former CEO and founder here. How do you describe what exactly is going on and what it would mean to just add another activist on top of all this pressure?
I would describe this as a three-way battle anyway. So Howard Schwartz is very vocal about his vision for Starbucks, even though he no longer has a position, in a management position in Starbucks anymore. So he's been very vocal about it. He's very vocal about not settling with Elliott. And all in all, it just seems like if you're at a CEO seat at Starbucks right now, and let's not forget that he only took this seat 18 months ago, you're actually battling two fronts anyway. So whether it adds another activist into the mix, whether Starboard is in there, actually just like adds another complication, but it actually doesn't make it any like less or more complicated.
Schultz is the not only the former CEO, but I think the biggest individual shareholder as well. He's unhappy, and the reason these activist investors have a room to come in is Starbucks' performance has been bad, right? I mean, they're closing up stores, sales are down. What's the problem?
So the problem here is a lot of retailers, they're battling with labor issues. Not only is it that it's hard to find workers, there's also a unionizing effort within Starbucks workers. And obviously, they make coffee with humans still. So there are a lot of talks about whether... Still.
Not for long?
Not for long, maybe. You know, like there are a lot of talks about whether they could like use robotics in some of this, some of their coffee making, and also whether they can, improve their app experience. Laxman, this current CEO, has been rolling out this online strategy, whereas actually Howard Schwartz has been saying that we should probably stop doing mobile order so much. But it has been actually a big revenue driver. So that's like the conflicts within the boardroom, inside and out, is actually making this quite a complicated and interesting situation.
We should say CNBC also reporting now that Starbucks and Elliott are discussing a settlement. And according to the Journal report, Starbucks was not...
Of course they're discussing. I mean, they're in talks, right?
Well,
so those talks continue today.
Crystal was making as well. You don't want, or at least Howard Schultz does not want, certain types of settlements here. What kind of progress? And we should also say here that according to the Journal report, they have not been made aware of an engagement by Starboard. So what is it that Elliott has been winning here, if they're winning at all?
So one of the biggest or like most important tool that an activist has in their toolkit is replacing the CEO. So a biggest thing for us to watch here would be whether the current CEO, Lexman, having been in this job for 18 months, will be replaced at the pressure of Elliott. Also, whether Elliott's representative of Elliott portfolio managers would get on the board of Starbucks and give more control and pressure the company more directly would be another thing to watch. But the Starboard thing is interesting because it adds extra pressure to the company now, because you would probably want to settle more quickly with Elliott given that extra pressure.
The pressure is on. Bloomberg's Crystal C covers everything activism for us. Now, coming up, we're going to talk about Hawaiian Electric raising a going concern warning after the Maui wildfires ravaged Lahaina last year. We're going to have more on the potential price tag from one of the worst wildfires in U.S. history. Social Climbers is up next. This is Bloomberg. It's time now for Social Climbers. The company's making waves this morning. First up, we're talking about Hawaiian Electric, issuing a going concern warning and pegging liability from losses from the Maui wildfires at $1.7 billion. Last week, the utility company agreed to pay almost $2 billion as part of a settlement to resolve hundreds of lawsuits over wildfires that killed dozens of people and destroyed the historic town of Lahaina last year. Next, Rocket Lab USA says it successfully hot-fired its new rocket engine, Archimedes, for the first time. The aerospace company also posting record revenue and a narrowing of its second quarter loss. Finally, Intel is postponing an innovation event that was slated next month in San Jose, California. The chipmaker says it plans on focusing on webinars, hackathons, and the Intel AI Summit. The move follows a rocky earnings report last week when it reported a disappointing outlook and cut its dividend. And we'd like to make a correction on a story that we aired last week. We said 23andMe was exiting the DNA testing business and getting into the weight loss market. In fact, the company is planning to launch a telehealth membership program where users will be able to get GLP-1 medications. 23andMe will continue to offer DNA testing services, and we apologize for the error. You can follow all the latest company buzz on TREN Go on your Bloomberg terminal.
All right, I want to add, Sonali, another story that I imagine will be jumping up in the most read ranks right now. Moody's downgrading JetBlue's corporate family rating to a B3 from a B2. Now, this is key because Moody's is selling $2.75 billion in debt, or raising $2.75 billion in debt and loans backed by its loyalty program. Moody's says that it's going to take years for JetBlue's operating profit and cash flow to return to levels that would lead to materially stronger credit metrics, and that earnings continued to be pressured at JetBlue by the operating environment, including increased competition in key markets along the U.S. East Coast, which obviously is very important to JetBlue, higher demand for premium products, and the inability to match cost inflation with revenue growth. So problems in terms of JetBlue's earnings potential, at least according to Moody's, and as a result, they're lowering the company's corporate family rating. We're seeing a lot of companies come out for debt.
We sure are.
Before all of this data comes out, before PPI and CPI this week.
Well, that's the time to do it. There have been a couple times in recent years where you had the banks actually miss those windows, and it really messed up as different types of capital markets issuances. I also want to point out, it's really interesting. You look at JetBlue, we do the functions on our terminal of DDIS Go.
Love it.
That's what you can see in terms of how much debt they have outstanding so far. That would be more than $2 billion already, with 11 total issues. And it's interesting to me that JetBlue is one of those companies that are backing their bonds by something somewhat esoteric, those loyalty programs this time around.
Yeah, very interesting. I love that function. DDIS Go shows you the debt distribution. Oh, there it is. And when those debts are coming due. Coming up, Northern Trust's Anwiti Bahuguna explains why she's comfortable being overweight equities after the volatility last week. Moments away from the start of trading, this is Bloomberg Open Interest. I'm Matt Miller. We descended into calm on Friday afternoon, and it persists today. You can see the S&P 500 and the NASDAQ both up about 0.2%. No major moves. And by the way, the VIX has fallen back to pre-non-farm payrolls numbers. So everybody's pretty chill. Down at the New York Stock Exchange, we can see TPL ringing the bell there. I'm going to get something to do with Texas. And here at the NASDAQ, you see IYF, I should say, transforming lives together. A quick check on how the averages are doing just seconds into the trade. We're looking at bigger jumps than were indicated by futures. The S&P 500 up about 0.25%, NASDAQ up about 0.2%. The small caps are running at the rear right now, only up about 0.1%. One stock to watch this morning is Starbucks. We've been talking about that this morning after a report that activist investor Starboard Value has taken a stake in the company. Now, we should say we haven't independently verified that. We don't know it to be true. The Wall Street Journal said, though, that Starboard has taken a stake in Starbucks after a couple of rough quarters. We do know that Elliott is involved, and we also know that Howard Schultz has had a bad opinion of the way that company has been operated. Sonali?
I want to also take a look at KeyCorp here. Of course, after Bank of Nova Scotia took a minority stake in the U.S. bank, Scotiabank said it would buy about 15% of KeyCorp as it weighs a restructuring of its balance sheet. KeyCorp up about 16% this morning. We're also watching shares of JetBlue, the airline's long-term corporate family rating downgraded by Moody's to B3 from B2. You have, however, you do have a JetBlue moving after that bond issuance. We're going to take a look here with Bloomberg's Abigail Doolittle.
Yeah, it's absolutely plunging here, Sonali. Take a look at the shares of JetBlue, down 13.1% right now, really down given the fact that this stock has been down since its peak, down since 2004. We'll be taking a look at that in a moment. But relative to the debt deal sale, $2.75 billion, $1.5 billion in 7-year bonds, callable in 3 years, and then another $1.25 billion of 5-year term loan, and it will be used to raise reserves and fund general corporate purposes. Basically, they're looking to bulk up the coffers. Now, if we take a look at this stock and the airlines in particular against the S&P 500, we're going to see some massive underperformance. We actually don't have JetBlue in here in particular, but since JetBlue's peak, down about 80%, so very similar here to, actually, that is JetBlue, so excuse me, but down about 80% from its peak. Back in 2004, it hasn't put a peak in basically 20 years, and you can see the performance of the S&P 500 over the last 5 years or so. One thing that's really interesting about this, Matt, if we take a quick look at the company's debt load, I believe that this new debt offering is going to be added to this amount. The company's market cap right now, about $2 billion, so these airlines really strapped with debt. This is a big picture. Investors not liking the fact that there's going to be more debt added to this, and therefore that stock down more than 10%, because, of course, stockholders come below the debt holders in the capital stack should things go awry.
Absolutely. All right. Thanks very much, Abigail. Abby, looking at the airlines there. Let's talk about stocks posting modest gains at the open. But at the end of last week, we clawed back almost all of the ground we had lost Monday. Still, Deutsche Bank says that investors are at the lowest allocation of stocks that they've been in some time relative to history, about the 31st percentile right now compared to the 95th percentile just about 3 weeks ago. Joining us to talk about this is Anwiti Bahuguna, CIO of Global Asset Allocation at Northern Trust. Anwiti, thanks so much for coming on the program. Do you think investors are going to stay this bearish on stocks? In terms of their allocations, it looks pretty weak, or will that bounce back just like we have seen with index prices?
Morning, Matt. It's a pleasure to be with you. I think it'll be the latter. We have seen stock market gains despite this general aura of bearishness that we hear from investors, and actually know that there are large holdings of cash on the sidelines. So it's quite possible for this rally to continue, in my opinion.
When you think about the cash on the sidelines, one question that I've been having is how sticky is that cash? Because even if you get that one rate cut, you have a lot of money in money market funds that doesn't tend to just flow out of those funds, does it?
It doesn't, but there is a tendency for the participants to chase performance, Sonali. So it is possible that when they see the persistence in performance, and we've had that now for about 9 months, and at the same time, the feeling is ratified through rate cuts, that rate cuts are coming. There'll be more than one, for sure. That sort of participation in stock market can give you so much better returns than what you get from cash once you factor in the future rate cuts.
In terms of the data that we're going to get tomorrow at 8:30 PPI, on Wednesday we get CPI, do you expect to see wild swings, the likes of which we've seen over the last few weeks when these little data points come in? And do you hedge against that?
Hey, Matt, yeah, that's an excellent point. Actually, when we look at the data right now, the options market saying that we could see plus minus 1% swings based on inflation data this week. But we don't actually make such short-term calls. Our time frame is typically 6 to 12 months. So this is really in the realm of things noise at this point.
Well, if you think about the noise that we have been seeing as well, some of this has actually nothing to do with the macro at all. Of course, we're watching a calm market headed into this week, but you still have the reverberations in the minds of investors from what we saw a week ago with the unwinding of the carry trade. To the extent that there's more positioning noise under the surface, how concerned are you?
Sonali, that's an excellent point. I think this started as a positioning event, and you saw that in the end, fundamentals dominated, right? So we had the positioning unwind of the carry trade. We had some sort of, I would say, broadening in the U.S. equity markets also, where positioning has been so concentrated in the tech sector. And to me, all of that, Sonali, is great news. I'm looking for this broadening to happen, looking for positioning to flow towards other areas of the market where earnings are actually coming in quite strong. So there are obviously these periods of transition where folks move away from this narrative of inflation to now maybe broadening growth, and something to watch for. But these are opportunities to actually adjust your portfolios to where you want them to be.
Are you concerned at all about, earnings coming down? We're looking at, 11 or 12% for Q2. I think analysts are pretty bullish in terms of the full year, 9, 10, 11% for earnings growth. Does that still track?
Absolutely, Matt. In fact, when we started the quarter, I think expectations in the market were somewhere around 9%. And we are seeing, as you mentioned, closer to 11% in earnings this quarter, I'm sorry. And our expectations for 12 months ahead is around 12% also. But as I said earlier, I think the most heartening thing for me is that earnings are broadening. They're not concentrated in one or two sectors. And that, I think, is great news.
Anwiti, thanks so much for joining us. Anwiti Bahuguna there of Northern Trust talking to us about her expectations for stocks and the economy in a sense. I mean, it's interesting. We got almost a growth scare a couple of weeks ago with the non-farm payrolls number, and I realized there were positioning issues that helped to drive the market down on Monday, but we clawed back almost all of last week's gains after the unemployment claims number came out better than expected. And people seem pretty sanguine now about the economy in the face of only 25 basis point cuts expected from the Fed.
And we have a ton more earnings left. I mean, not a ton. We're mostly done, but some big ones. Walmart is coming up. Nvidia is still coming up. What's interesting here from the earnings story so far, according to Bloomberg and Bloomberg Intelligence here, is that there is expected to be, outside of the Mag 7, the first profit growth for all of the S&P ex Mag 7 since the fourth quarter of 2022. There's another index I want to take a look at here quickly, Matt, and that is that KBW Bank Index, because you have almost every stock here in the green after that deal from Key Corp here from the Scotiabank. Yes, 15% higher for Key Corp, but Comerica, First Horizon, both up 4-5%, almost every stock in the green. On the flip side, want to take a look here at B. Riley Financial. The stock is had been halted. Yes, it now is trading once again. It had fallen as much as 50% or more, now down about 48%. It is facing a wider probe on its risk disclosures. Remember, this is a small stock in the scope of things here, but a boutique bank nonetheless. A tough moment for that stock.
Right, and together with it, right? So the write-downs have to do with a retail investment, and now the SEC is looking into the CEO's relationship with the head of that retail business. They have a close business relationship, and that's just not the kind of headline that you want to see if you're an investor. Coming up, villains taking center stage at Disney. We'll look at the company's new theme park strategy next. This is Bloomberg.
This is Bloomberg Open Interest. A quick check on stocks this morning. It is a calm day in the market, but we are not holding on to the green territory that we had been in. S&P 500 flirting with red territory now, pretty much flat on the day, but all major indices here now turning into the red mark. The Russell 2000, deeper declines here, about 0.1%, almost 0.2%, Matt.
Did you say indices?
Is it indexes?
You know, Bloomberg style, official style is indexes. The whole company has to get with it. All right, let's get to top calls right now. Some of the analysts' action in focus this morning. First up, Deutsche Bank says Eli Lilly is a buy. It's also raising its price target on the pharma giant to $300, or by $300, I should say. The firm says the company's big beat and raise in the last quarter settled some nerves in a volatile macro backdrop. You can see the shares not doing a lot this morning. They're leading a pack of companies out to raise some corporate debt before PPI tomorrow. Next up, Piper Sandler recommending Robinhood as a buy and raising its price target on that stock as well. Robinhood reported earnings and sales that topped analysts' estimate for the quarter last week. The analyst cites near-term catalysts and longer-term growth opportunities for the optimism on Robinhood. And finally, Goldman Sachs initiating coverage of Kraft Heinz with a sell rating and a price target of $34. The company sees a choppy path ahead for the food and beverage giant as it attempts a strategic pivot. And as a result, Kraft Heinz shares are down almost 1.5%. Sonali?
There's another stock we're watching here at the Open. It's Disney. It turns out the happiest place on earth has a dark side. The company is revealing a number of new theme park attractions, including the first devoted to movie villains. Joining us for more is the co-host of Bloomberg Technology, Ed Ludlow. And you think about just kind of the state that the theme parks have been in lately, the crunch on the consumer. How much can the villains draw people out to play?
Shout out whoever cut that villain montage. That's OG, some of those. I mean, this is fleshing out a plan that Disney gave us in September. $60 billion of capital investment over a decade. But the villain-specific theme park resonates with all of us. It must resonate with Matt Miller. It's going to be at Magic Kingdom in Florida. It's going to be equal in scale to that of the Star Wars theme land, which I've been to in Southern California. But again, for investors, it's kind of a patience thing because construction on those projects won't start for another 5 years or so. And even though it's a big spend, they do take time to get people through the gate. And as you guys know right now, consumers have cut back, particularly on the low-income side, as reflected in Disney's theme parks miss last quarter.
The kids today, Ed, would probably think of Hans of the Southern Isles, the bad guy in Frozen, as a villain. But
or
the
like
greatest
Te-Kā from Moana, something like that.
Exactly. The greatest villain of all time would have to be Darth Vader. Is he going to be at this park too?
Controversial of all time because Darth Vader of Star Wars, now owned by Disney through acquisition of Lucas. But when I think Disney villain, I don't think about the Star Wars or Marvel universes. So that's an interesting spanner in the works. They're doing a lot of other stuff as well, right? Like they're going to have a Cars-themed park of significant scale and attraction in the same Magic Kingdom position in Florida. And I don't know if you guys saw, but they're also going pretty deep into the cruise industry with expansion of what was already ambitious plans for additional vessels, particularly, maybe in markets like Southeast Asia, because there's demand there. But just remember that in the moment, we are worried about underperformance of this unit because it underperformed at a time where streaming in particular did quite well last quarter. But parks and cruises and attractions has been the profit driver historically.
It's interesting. Those cruise ships in particular, I'm interested about because I think about a conversation I had recently with the Royal Caribbean CEO, and he would say to me that he's competing with land attractions. Disney has some of the ultimate land attractions. Do investors have patience for not only their expansion, but also the cruise ships?
They're going to have to because the cruise ships, when you build a vessel of that scale, you're talking about a very long timeline. 2027 to 2031 is when they kind of materialize in the oceans. But you raise a really interesting point. I hear it all the time on Bloomberg Technology. A competition for wallets and a competition for eyeballs is multi-medium. You are trying to get consumers to spend money at a budget in a specific place. And, one thing that Disney said, it kind of ties across theme parks and their cruise line ambitions, is that they're very good at being strategic, discounting for those demographics that are responsive to incentives and discounts, placing their bets in specific markets, vis-a-vis Western Europe or North America, et cetera. So it's a long payoff, but the stock's down like 0.6% right now. It's nothing for the here and now.
Ed, thanks very much. Bloomberg's Ed Ludlow there is the anchor of Bloomberg Tech. You can catch him at 11 a.m. in a show that you don't want to miss. Sonali, I'm always fascinated by these cruises. I've never been on one of the big boats.
Seriously?
To me, it seems like prison with shuffleboard. Have you been on one?
I have, but not since I was maybe 13 years old. However, they are getting pretty souped up, I hear. I'm more interested in this villain park. I am more intimidated by going to Disneyland than most people. A lot of people scare me.
Oh, really?
In one place.
Oh, you don't like the crowds. I get it, yeah.
But I would go for Scar and Mufasa.
Yeah, I have great memories of going to Disney as a kid, and I can't wait to bring my kids there as well. But I think they would be too afraid of the villains.
You've
got to be a certain age.
From bad guys too, you know.
Yeah, you can learn a lot for sure from your fears.
So coming up next, we're going to turn to the Wall Street beat. We're going to look at more villains. We're going to look at the Wall Street villains. We're going to talk about creditor-on-creditor violence and its impact on funds. We're going to take a look at markets before we let you go to break because, of course, we're turning deeper into red territory on those indexes. S&P 500 down about 0.3%. NASDAQ 100 in conjunction. The Russell 2000 is where you're feeling a little more pain, almost 0.4%. We'll keep an eye on it. Stick with us. Time now for the Wall Street beat. This morning, we're taking a closer look at creditor-on-creditor violence. Lenders are scraping over how much money they can get back from ailing companies, and it's the focus of today's big take. Joining us now is one of the reporters on the story, of course, Bloomberg's Laura Benitez. And it's interesting because, let's say a year ago, we sat here with all these massive credit funds, and they all said, no way, the market is different now, we're all friends, we need to behave nicely with each other because otherwise, on the other side, people won't want to do business with you. Yet now you're standing here seeing some of the worst violence in credit markets that you've ever seen. What's going on?
That's right. And I think the difference, or one of the bigger differences from a year ago, is interest rates. Obviously, interest rates are higher now, and companies are really kind of finding it difficult to service their debts and to keep their balance sheets in good shape. So they're having to come up with lots of creative ways to keep the music going and to keep surviving for another few years. So we're seeing more and more kind of, innovative restructuring solutions being pitched. And this is where we're at with the peak in creditor violence.
This is the first year I've heard that creditor-on-creditor violence phrase. And
really?
But it's a dog-eat-dog world. I mean, were they much kinder and gentler to other creditors in the past, Laura?
I think this has been coming for a long time. It's been coming in stages. We first saw it with J. Crew, and then since then it's been happening more and more. And the reason it's been happening more and more is because there's been absolutely no protections, so no investor protections. I mean, there are some, but they're very, very loose, and that's been deteriorating for about a decade. So now we're at the point where companies are finding it harder to refinance. There are no protections in the bond doc, so lenders can do pretty much what they want, and companies can get creative and, cause some aggression, some mayhem.
Laura, if you are an American hanging out in your car, driving across the country, you might be listening to iHeartMedia, for example. You might not know that that's one of the companies engaged in this. Are they like a poster child here of some of what we're seeing? What's playing out under the surface that doesn't meet the eye?
I think that situation is just symbolic. So at the minute they're trying to restructure their debts, they're doing so with a select group of creditors. So that select group will be in conversations and they'll be trying to cut some sort of deal. For the other creditors that are not included in that group, it's quite nerve-wracking. You're not included in those talks. Anything could be happening. They could be planning to prime you to be more senior. They could be pledging assets that you might have thought were yours elsewhere. So it's just kind of symbolic of just where the paranoia is in the market at the minute.
All right, Laura, thanks very much. Great story. Congratulations. Laura Benitez there talking about today's big take. Let's get you to the trading diary. This is what you need to be watching this week. We get the New York Fed's one-year inflation expectations in just about an hour and 5 minutes. Then tomorrow we get the PPI data, producers' prices. They come out at 8:30 a.m. Earnings from Home Depot coming out tomorrow as well. On Wednesday we get the consumer prices, the CPI data, and then we get earnings from Walmart and Deere. So some really big hitters out with earnings as the last 40 or 50 or so companies on the S&P still have to report. This is Bloomberg Open Interest. I'm Matt Miller. We're looking at stocks that are down as the market turns around. Stay with us. We are 30 minutes into the trading day. Markets headed lower. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Basak. Katie Greifeld is off today. And coming up, we're going to talk about stocks. Even though they're in the red at the moment, they are on calmer footing as investors await key data this week, which will shed light on the health of the U.S. economy and the outlook for the Fed. A new poll shows Kamala Harris gaining an edge in 3 swing states. We're going to bring you the latest on the race for the White House. And as investors weigh the risks and rewards of artificial intelligence, the CEO of Lumen is going to talk to us about how her company is cashing in on the AI boom, Matt.
All right, let's get a check on what's going on in the markets. We kicked off the trading day, just the first few minutes, we were up about 0.25% on the S&P, and now we're down about 0.25% on the S&P. So you have seen a decent swing here. The Nasdaq down 0.3%. In terms of the 10-year yield, we were on 4% watch. It was heading higher, and now it's heading lower. So much for the disinversion.
So much for the disinversion. We're going to talk more about what it means all for investors gearing up for a busy week of economic data ahead. We're going to get New York Fed 1-year inflation expectations today, followed by key inflation data Tuesday and Wednesday. That's when we're going to be watching the 2-year and the 10-year to Matt's dismay, perhaps. And we're going to get...
I'm excited about it.
That 2-year. We're going to get retail sales data on Thursday and University of Michigan sentiment data on Friday. Brooke May, managing partner at Evans May Wealth, joins us now on how she's positioning for that week ahead. And Brooke, you take a look at all that data ahead. How concerned are you at this juncture about the state of the consumer? There's a lot of eyes, of course, on inflation, but equally as many on that retail sales data we get right after.
We're watching closely. As we've seen in recent days, the data is mixed, and the market is reacting to single data points, where the Fed is looking at the totality of data. So we think that, CPI coming in this week, we expect it to continue to decline, but we're looking at the trend more so than single data points.
But you are bullish after last week's swings. Did you buy the dip on Monday? Do you continue that strategy?
We do. We think that the market is going to grind higher between now and year end, but we're fully setting the expectation that clients should expect volatility in the weeks to come. The Fed, we've got 5 more weeks until they make their next rate decision, and we think at this point it's almost imminent that they're going to cut. The question now is it going to be 25 basis points or 50 basis points?
Well, we did a survey last week of economists at the biggest banks. 4 out of 5 said they still only expect a 25 basis point cut. And I just wonder, that combined with the geopolitical problems in the Middle East, the election year, the potential for debt servicing costs to be $1 trillion. I mean, all of these down arrow stories don't seem to deter anybody who's bullish stocks. Why?
Mm-hmm. Well, you look at the labor market, and we've clearly seen unemployment tick higher. We had 2 years where unemployment was below 3.9%, and now it's at 4.3%, which, if you compare that to a historical average, I think since World War II, unemployment's been around 5.7%. So we're well below that average, and the consumer and the labor market is what has held up this economy the last few years. Corporations have struggled with higher interest rates, but the consumer has continued to spend because if people have jobs, sentiment is good, and people are willing to go out and spend.
At what point do you start to get concerned? You look at parts of the market now, you've seen a lot of divergence, but you've also seen a lot of catch up here. When you think about the kinds of names to buy and stay away from, how are you parsing that pool right now?
Mm-hmm. We want companies that have a strong balance sheet and good earnings guidance, no more than anyone else. We're still in the camp that we're overweighting big tech. We think that these are buying opportunities. When you look at those companies' earnings, they're not bad. For example, Microsoft. There were concerns around cloud revenue, but overall it was a good earnings report, and the stock sold off 6 or 7%. Look at Amazon. They had a little bit of softening in their retail sales, but AWS was very strong. And so we're looking at individual companies. There's more of a divergence right now in returns than there is historically. So you have to be very specific in the companies that you're looking at. And we don't buy sectors. We're looking at individual companies. A great example, last year, the best performing stock in the S&P 500 was a tech stock, and the worst performing stock in the S&P 500 was a tech stock. So we're going company by company and doing a bottoms-up analysis.
Excellent. Brooke, thanks so much for joining us. Hope to get you back soon. Brooke May there, managing partner at Evans May Wealth. Thanks so much for joining us. I want to turn to the race for the White House. Kamala Harris now leads Donald Trump in Wisconsin, Pennsylvania, and Michigan, 3 critical swing states that have been called the Blue Wall. This according to a New York Times Siena College survey. Joining us for a closer look at the state of the race is Bloomberg's Kayleigh Lines, anchor on Balance of Power, who joins us here in New York. Great to have you back in the city.
We've missed you.
We've missed you, although I listen to and watch your show every day. This has been one of the most fascinating political turnarounds that I've seen in my life, right? From Biden was way behind the polls. Now Harris, Walz seem on their way up. Can they keep this momentum? Yeah.
Well, that's the question. Of course, they're going to have an ability to continue the energy next week in Chicago. The DNC begins a week from today. So at the very least, they will be able to count on that coverage and that kind of gathering of the Democratic Party to sustain the momentum at least through the end of next week. After that is when it really becomes a question. But what we've seen is in pretty rapid order, given her campaign is only 3 weeks old, she has been able to make a material difference in the standing of the Democratic ticket in these polls. This one being the latest one, as you said, Matt, this is considered the blue wall. It is the easiest path for Democrats to get those 270 electoral college votes. And in this poll, she's leading Trump by 4 points across all 3 of these states, 50 to 46. Granted, the margin of error is anywhere between 4 to 4.5 points in each of these states. So you are still largely within that. But this is really critical, especially when our own polling in swing states that include others beyond this with Morning Consult has showed she's gaining ground from where Biden was in the Sun Belt as well. So it's opening up states like Arizona, Georgia, maybe even North Carolina that were more closed off to Joe Biden.
You started to make this point also about the DNC just being next week. Until this point, we've seen a lot of excitement around Kamala Harris, but very thin on details in terms of what the platform will be. How much risk does the DNC really pose, given we've seen such a swing forward in her momentum? How much can she... What's the margin of error there in terms of what could happen next week?
Well, it could be substantial. Obviously, she will have the chance to speak on Thursday evening, the last night of the convention, as the official nominee. Granted, she already is because of the virtual roll call, but that is where we could actually see her outline policy in a more material way. We're starting to see it on the margin. For example, in Las Vegas this weekend, she said that she was going to be adopting a policy that actually Donald Trump put forward first, no tax on tipped wages. She's put that out, but in terms of the other economic policy, it's still a little bit fuzzy. She wants to bring costs down. She'll be talking about that in Maryland next to Joe Biden this coming Thursday. They'll be campaigning together, talking about how their administration has lowered costs for the American people. But she's yet to really define how she wants to be different than Biden in terms of economic policy. I would note in the Times Siena poll, it does show voters in these states still trust the president or the former president more when it comes to the economy. But a new poll from the FT and the University of Michigan Ross School of Business found Harris is actually 1 point ahead on the economy issue. It's the first time we've seen a Democrat do that this
There are a lot of things that she has yet to define, really, and she hasn't given any interviews. She hasn't held a press conference. The only gaggle that she did, I read, lasted 70 seconds. Trump called her out at his press conference, where I saw you furiously fact-checking every statement that he made. But why are they afraid to put her out there?
Well, the fact of the matter is she on her own right now is earning a lot of free media, that she doesn't necessarily have to sit down for an interview. She's kind of collecting the coverage given the nascent and rapidly ascendant nature of her candidacy. She isn't necessarily, according to Democratic strategists that I've spoken with, needing to sit down for interviews in order to get attention. That said, the pressure is growing on her to do that, actually answer some questions. We've seen Donald Trump do that not just at the news conference at Mar-a-Lago last week, but he's going to do it again tonight with Elon Musk on X at 8 p.m. Musk has described this as a no-limit conversation, unscripted. So that's going to be another chance that we see Donald Trump talking off the cuff and not seeing the Democratic nominee do so.
Well, it's an interesting moment, right? Because you have a former president here that's been pretty critical of the electric vehicle industry and a lot of the concessions that the Biden administration has given the electric vehicle industry. You can't imagine that that is the main point of discussion, though.
Well, and don't forget that Elon Musk supports Donald Trump for president. He's come out publicly and endorsed him and is planning to give millions of dollars a month to a Trump PAC. So it's not exactly an unbiased interview.
No, it likely won't be. And granted, a lot of the interviews we've seen Donald Trump do, including on networks like Fox, don't tend to be as unbiased as they may be otherwise. That said, it is an open forum where anything could happen. And what we have seen from Donald Trump, while his campaign itself is much more disciplined this cycle than we've seen in the past, the candidate isn't necessarily. While other Republicans are trying to stick to specific policy messaging, hammering Harris on the border and the economy, Donald Trump has really had difficulty staying on that message and not resorting to personal attacks that have stuck with him, like, for example, at the NABJ conference, talking about questioning Harris's racial identity. So it'll be really interesting to see in these unscripted moments, especially with someone who aligns with him to a large degree when it comes to politics and personalities, if there actually is some room for error for Donald Trump tonight.
You know, before we let you go also, I want to get your view here on the most recent President Biden interview and what he said and what kind of insight it really gives into his decision to step down and kind of what he had said about Nancy Pelosi as well. You know, what did this really mean, not just for Biden, but what it could hint at in the future?
I will say this interview that he gave and his answers regarding why he made this decision were really in keeping with what I'd heard largely in Washington, which is it not just came down to whether or not he could win the presidential race, but whether or not Democrats were going to be able to keep control of either chamber in Congress if he was at the top of the ticket. And that's essentially what he told CBS, was he was worried he was going to be a distraction, that leaders, as had been reported, Chuck Schumer and Hakeem Jeffries, had suggested they may have difficulty either flipping the House or retaining the Senate with him at the top of the ticket. And if you are going to have a Republican in the presidency, potentially, you need that check if you're the Democratic Party. So it was concern about the impacts he could have down ballot. That seems ultimately to have been what caused Joe Biden to make that decision those 3 weeks ago. And of course, Nancy Pelosi is a factor here as well. She's been on her book tour for the last week, as her book just came out a few days ago, talking about how it wasn't that she wanted to see Joe Biden out of the race, but she wanted a candidate that can win. And she cares a lot about those majority makers in the House, and not being able to make that majority with Biden at the top of the ticket was certainly a factor.
Kayleigh, we have to leave it there. It's been such a pleasure to have you in studio with us. Of course, that is Bloomberg's Kayleigh Lines, co-host of Balance of Power. Of course, tonight we will also be listening to that Trump interview. Stay up late.
I will wait, and then I'll watch Kayleigh and Joe's take on the interview.
And ours tomorrow as well. Now, coming up next, we're going to talk about all that glitters. Barrick Gold profiting from higher gold prices. We're going to get all of the details from the earnings with Mark Bristow, Barrick Gold CEO. This is Bloomberg.
Let's get now to high interest to look at what's making headlines around the world. B. Riley Financial facing a widening U.S. probe into whether it gave investors an accurate picture of its financial health amid a string of losses and a sagging stock price. The SEC is investigating possible improper trading at the LA-based financial services company, and it's seeking more info on founder Bryant Riley's longtime relationship with Brian Kahn, the former CEO of the franchise group, which is related to its multi-$100 million write-down. OPEC trimming forecasts for global oil demand this year and next as well, ahead of the group's planned supply increase next quarter. Although the forecast remains higher than the rest of the petroleum industry, the 135,000 barrels a day cut in expected growth is the first significant change to the cartel's forecast. And the U.S. is shoring up its naval and air forces in the Middle East to help Israel fend off any major attack from Iran ahead of a planned resumption in the Gaza ceasefire talks later this week. Israel has also been bracing for an assault from Iran or its allied militia groups since back-to-back assassinations of senior Hezbollah and Hamas officials 2 weeks ago. Sonali?
And on the heels of escalating geopolitical uncertainty, we're going to take a look now at how oil has been reacting. Bloomberg's Abigail Doolittle is here to explain.
Well, this is a multi-day chart here of oil, Sonali. Matt was just showing us how oil is higher today, in part because of the tensions and in part because of those OPEC forecasts. But something I would like to point out is last week when we had the real de-risking with the S&P 500 and the other stock indexes falling, it wasn't just the stock complex that fell. It was also the commodity complex, because these are, of course, risk assets as well, tied to the growth of the economy. But you can see a nice recovery over this entire time period, up 1.3%. But there's something thing I would like to point out, which is this has not been the case all along, at least in terms of commodities more broadly. Over the last 2 years, you can see the S&P 500 up a very healthy 25%. The Bloomberg Commodity Index, though, heading to a second down year in a row, right now down 22%. Mike McGlone and some other BI analysts here at Bloomberg last year expressed concern about the drop for the Bloomberg Commodity Index, saying that they thought that it was tied to the economy and that there could, in fact, be some sort of a recession ahead. We don't know that for sure, but what we do know is beneath the surface, if we take a look at different commodities, the yields for corn and soybeans in the Bloomberg terminal, they're pretty high. So this is one reason to think that we could actually have depressed prices for some commodities, namely the grains. And this is a long-term chart, 25 years or longer. And you can see really per acre, we're greater than 50% yield. So that could and is, in fact, depressing the prices for at least these two grains, corn and soybeans. If we take a look at what's happening over the last year, we're going to see corn and soybean under quite a bit of pressure. On the other hand, take a look at the metal complex, Matt. We do have copper up 6.2%, even though it's down 20% from its recent peak. And then gold futures up 21%, very close to its all-time high.
Wow, gold at 24.88. That is bullish. All right, Abby, thanks very much for joining us. Abigail Doolittle looking at commodities for us. I want to stick with gold right now because Barrick reported earnings this morning. The miner announcing it bought back nearly 3 million shares in the second quarter, maintained its quarterly dividend. You can see the shares are up more than 6% in a down market. Joining us to talk about this more is the CEO, Mark Bristow. Mark, great to have you on the program. Thanks for joining us. I wonder if, the buyback and the earnings beat, all this positive news is enough to catch up with your rivals in terms of your share price performance because you've lagged the biggest competitors out there.
Hello, Matt. Nice to chat to you again. Yes, it's always easier to come from behind, So good set of results, nice margins. We were able to really deliver the margin from the rising gold price into the bottom line, which is good. Margins on gold were up a lot, even more so for copper. Prices were flat, and those prices will start coming down now on the back end of this year as we address some of our investments in sustainable production and at the same time bring up the production on some of our core assets. And I think what's really starting to resonate with the market is the fact that we've got real growth, that we did our deals back in 2019, 2020. Embedded in that, there were no premiums paid, and now we've got some world-class assets that are starting to show themselves for what they are, and supportive of our announced 30% growth by the end of the decade.
Mark, elsewhere this morning there was a $1.6 billion deal announced in your industry of Gold Fields and buying a Canadian company here, giving them control of a full project in Canada. Wondering about your reaction, your competitive reaction. Is this the time now for more M&A, and can you see yourself pursuing deals to be expanding?
So, Sonali, nice to chat to you as well. This is a deal that Gold Fields bought half of the asset just a little while ago. It's buying the whole company now. It fits maybe with Gold Fields, definitely doesn't fit with the Barrick size and return that we look for. It's very interesting, some of these transactions. We've seen the BHP Lundin transaction on copper in Argentina. We're very cautious on doing big M&A transactions that are long dated on the delivery in a hot market like we've got today. I think what we're showing is that we've got lots to deliver from the transactions we did 5 years ago, and they are real value creative transactions, not just relying on an increasing commodity price.
Mark, I'm curious as to your take on the value of gold as a hedge against inflation. As you mentioned, your margins are stronger, and cost inflation for you has peaked. Really, I think for consumers as well, and yet gold continues, in terms of price, its march ever higher. Not really on the back of a weakening dollar either. What's driving this rally, if not inflation or weakness in the greenback?
You know, Matt, I've spoken to you about this before. The risk of a hard landing is still real. And we saw that little anxiety come through the markets a week ago. And the dollar is weaker relative to the gold price. That's the ultimate measure because the dollar is the strongest of all the paper currencies. But what it's showing is that, and the developed economies are all having to deal with very large amounts of debt relative to their GDP. So the global economy is not in good shape. China is not where it was just a few years ago. And neither are any of the developed Western world economies. So, and the gold price is telling you that. So, and what's interesting just recently is that we saw a big focus on buying physical gold, which drove the gold price up, you know, to the 2,200 and above. But now we're seeing a move back into the ETFs, and it's nice to see the reaction in the equities. And this is the what we invest in Barrick is we invest in high quality assets, and ultimately the market recognizes that, and you'll get the lift up in the equities. And at the same time, our returns to our shareholders through dividends, capital returns, etc., has been on a level with our peer group. We've got embedded value in our business, and we don't have to go and do M&A, although we never give up on M&A, but we don't have to go and do it at a level where it's not easy to see value creation.
Mark, I'm equally interested here to talk about copper. If you think that a risk of a hard landing is still real, and copper had slumped 19% from its May peak, you do see a rebound now, but do you think that there's a bigger floor of copper prices that you have to be aware of here?
Yes, Sonali, absolutely. I mean, we've all talked about a very volatile next 2 years in copper. You know, copper really gets driven by many factors. One of them is the global economy, the perception of economic health in the world today. At the same time, we saw a sudden tightening on the supply side early in the year, last year as well, with the Panama situation. But we haven't seen the pull on the buy side yet. But ultimately that'll come because the copper industry is ex-growth. It will come. I've always said, you know, our expansion in Barrick into the copper business comes in 2028. It's a great time to bring new copper production into the world. And so we're very comfortable with our investments. We do believe ultimately copper is in short supply, and it's going to get shorter and shorter. And so that's good for the copper price. But in the next 18 months to 24 months, it's going to be very volatile.
Mark, great to get some time with you. Thanks so much for joining us. Mark Bristow there is the CEO of Barrick Gold, and the shares are on a tear today. Let's get a check at the rest of markets right now. We have seen a flip back to green here. The S&P 500 currently back up 0.25%. The NASDAQ 100, the Qs there up about 0.5%. The 10-year yield continues to inch lower. Maybe it should be measured in centimeters. It's very small, but 393, 394, the level there. Let me just pull up. You know, the 2 years important. When we're looking at the 10-year, Sonali, we're looking at 405 on the 2 year. So still 11 basis points in between them, and obviously still an inverted yield curve. We saw it disinvert for a brief moment last week.
You know, it's fascinating. Most major sectors actually today in the S&P 500 still in the red, which is why you're feeling that pain under the surface. Real estate down almost 1%. Information technology still up. I have a little bit of whiplash this morning, Matt. I'm not going to lie.
Yeah, I mean, suffice it to say, if NVIDIA is a gainer, and right now it's up 6%, that's enough to drive the indexes to a gain.
Well, we'll watch those indices. Coming up, though, we're going to talk to the CEO of Lumen, continuing to soar, securing $5 billion of new business. We're going to speak with Kate Johnson up next. Stick with us. This is Bloomberg. One of the biggest winners of the AI boom this year has been Lumen Technologies, the communications tech company recently securing $5 billion in new business. It will provide fiber optic connectivity to some of the world's largest companies, including Microsoft. The shares up 164% this year, outpacing NVIDIA, down 15%, 12% now today, but very volatile. We're going to talk more about what's happening under the surface with Kate Johnson, Lumen Technologies CEO, with us now. And it's fascinating. You have investors really scraping the world here, trying to figure out the scope here of the AI opportunity. From where you sit, what do you tell investors that are a little bit worried about how fast we're building into this fiber boom, this data center boom that is made to support that AI boom?
We're seeing a once-in-a-generation rise in demand for terrestrial internet services. That's why we're expanding our internet, our network, to build the backbone for the AI economy. We think it's 10, 20 years build out for the critical infrastructure required to support this massive spike in data workloads.
Why do you think we see the volatility in your shares, Kate? Because you've got a market cap of about $5 billion. That's pretty much exactly, the business that you've got on your books. It doesn't make sense to me that you would see, 10, 15, 20% jumps and drops here, because it's not a business that's unreliable. You lock in contracts for equipment that you then deliver.
Yeah, it's a good question. So first of all, super complex market right now, lots of volatility in the markets. But to your question, we're not at all surprised that there are skeptics. What we're doing at Lumen is really fundamentally different than anyone else in this sector. We've got a world-class network, fiber network that covers the nation, unique routes, diversity, up-to-date fiber, which is differentiating. But what's more is we're not taking cash and paying a dividend. We're taking our cash and building a digital platform to drive the best customer experience in networking, right? To make it secure, effortless, and quick.
I think what a lot of people don't understand is how to build a digital platform. There are significant infrastructure needs to do so. You, for example, just a couple weeks ago announced an agreement with Corning to increase that fiber optic cable capability here. How much, when you think about CapEx, how much do you have to invest for that physical footprint? How do you give people a sense of just how much needs to be on the ground?
We've been taking care of this network for decades. That's why we're so well positioned to capitalize on this moment. And we're continuing to do that with these partnerships. I think when we got the $5 billion of deals coming in, we were anointed as the trusted network for AI. And the reason is because we've cared for that network for a long time. And that's the physical component. I think what's really differentiating is this digital platform that we're building on top of it, which enables enterprises to consume these services in a fundamentally different way. And I think what we all learned in the digital era is that the customer experience is the product. And when you think about telcos and sort of the legacy customer experience, it hasn't been great. That's why we're so well positioned to win in this space.
What about your future revenue prospects here? It was really interesting. Not only has your stock been volatile, so has your bonds. And that can be pretty rare for many companies, but certainly not that rare for companies that are kind of on the cutting edge of this new technology. CreditSights has recently said that this new business, this $5 billion that we've been talking about, could solve a lot of liquidity needs for Lumen, but that debt investors should be skeptical until revenue grows at a faster pace, with revenue not expected to grow until 2027. How do you outline your revenue trajectory from here? Can it grow faster?
Look, there's three steps. The first is free cash flow stability. We're in the middle of a very significant turnaround, and these deals have given us the cash that we need to self-fund our transformation, which is amazing. It's a breakthrough. And by the way, we're at the very tip of this. This is the first step. We've got a whole lot more business on the hill that we're going after, which will continue to improve the story. But when it comes to free cash flow stability, we're there. We are there. The next step is using that cash to do a couple of things. Number one, continuing to care for and build out the world's best fiber network. And the second thing, obviously, is to continue to invest in this digital platform and pull out cost of the legacy business to drive more and more efficiency. We announced on earnings last week that we were going to drive out more than $1 billion in cost by the end of 2027. So the story just keeps getting better. Free cash flow first, EBITDA stability second, then revenue growth.
You talk about the legacy telcos, and I, lived through the dot-com bubble and saw how much we were paying to put fiber in the ground then compared to how much it was worth after the pop. Do you take any lessons from the experience of those early kind of internet pioneers as you attempt to, build something on this new revolutionary technology?
Yeah, it's all about penetration of the existing assets to deliver the return that was originally intended. And that's what we're seeing from a growth in these data workloads, is that we can actually drive the penetration to get great returns on the network. And we're super excited about that.
It's interesting. You have worked at major companies, Microsoft, GE, Oracle, and you kind of joined Lumen, and right before a time where there was kind of an economic slowdown, if you will, in the fiber industry. What have you learned from all of that? I mean, when you think about the concerns that are out there about maybe a soft or even a hard landing, how does this AI boom sustain itself through any potential slowdown?
So we're talking about building critical infrastructure for decades to come. And I came to Lumen to help drive a turnaround, to take advantage of this once-in-a-generation opportunity. I didn't come to tidy up the legacy telco business. Those customers, they deserve more. And that's what we're doing, is we're building the future, the trusted network for AI, so we can enable all of these customers that, frankly, the internet doesn't serve today, and move them to this new platform to allow them to thrive in the AI economy. That's why I'm here. That's what's happening. We're super excited by this momentum that we're seeing already. And we think it really rides out any momentary volatility or any questions about, the health of the economy today or 6 months from now or 12 months from now. This is a multi-decade story that we're writing.
Kate, there are a subset of people out there who believe AI is the technology of the future. There's a smaller subset that also believe that crypto is maybe even equally as transformative of the internet. They believe that AI, as it booms, that crypto could be more of a native, let's say, currency of the internet. Do you believe in the potential of crypto as well? And how does it dovetail with the needs of AI?
So look, when I'm looking at things from the growth of our business perspective, and AI drives massive spikes in data workloads required, which drives massive spike in data center growth, which drives a need for connectivity. Crypto driving the same increase in demand for data falls right into that storyline, and that's what we're interested in. So building out these networks to connect data centers for the largest companies in the world, hyperscalers, social platforms, cloud companies, that's what we're in the process of doing. And it actually doesn't matter what kind of data is running across them. It's about data volume and connectivity across the globe.
Kate, we thank you so very much for joining us. That is Kate Johnson of Lumen Technologies, of course, a company a lot of people have their eyes on right now. Now, let's stick with artificial intelligence. Armin Panosian, the co-CEO of Oaktree, warns that the potential upside of AI may come with some devastating consequences. Take a listen.
The biggest risk that I see with respect to the markets and to society in particular is artificial intelligence. Artificial intelligence clearly has the potential for very large economic gains, revenue increases, cost efficiencies, and that investment opportunity is really exciting. It's easy to disregard the societal impacts of those same efficiency gains. What happens to normal jobs that are become obsolete because of artificial intelligence? Think of cashiers or drivers. As artificial intelligence becomes a real alternative to physical labor in some of those areas, millions of people could be out of jobs. So who's going to retrain those people? Because if we don't figure that out, that there will be social unrest, or there could be social unrest because of joblessness. In terms of the markets, artificial intelligence clearly is getting a lot of support from the markets. But Just like the internet in the late 90s, there was this promise of revenues growing rapidly. While the gains are clear to see in terms of their potential, the timing of them is impossible enough. And if that timing takes a lot longer than investors expect, I would expect to see pretty violent resetting of valuations and potentially some losses for investors along the way.
What does this look like for an investor who's keeping a close eye on the economy, the job market, let alone investing in AI itself? It seems like the risk you're outlining here could impact many markets.
The attractive part of it and the scary part of it is that there isn't a monopoly on intellect that could be used to develop artificial intelligence technologies. There is a shortage of semiconductors and chips, but artificial intelligence allows economies and countries, and potentially those adverse to the US, to develop certain technologies and skills through artificial intelligence that could be problematic from a geopolitical standpoint. In terms of what investors should be looking at from the economy, it's hard to really have a leading indicator. I think, unfortunately, from the job market perspective, we're going to be looking in the rearview mirror probably after it's too late. So it's really hard to kind of pinpoint what economic indicators we should be looking for.
How do you think about this in terms of how people are behaving right now? Do you think most investors out there are ignoring these risks?
I think most investors are intoxicated by the opportunity in artificial intelligence. $160 billion being spent this year. That's just one data point. Another data point is a $3 trillion market cap for NVIDIA against $80 billion of sales on a trailing 12-month basis. Obviously, a lot of growth is expected for NVIDIA and for other businesses in the space, but that is yet to materialize, and it's impossible to know what the scale will be of an NVIDIA or other players in the artificial intelligence ecosystem. I think investors are just so focused on the opportunity set, on what it can be. As a result, you don't really focus on the risks. You're sort of just too excited about the opportunity.
That's Oaktree's Armen Panosian speaking with me as part of the latest edition of The Next Big Risk. Matt, I do this twice a year. We talk to big investors to look over the next 5 to 10 years. I've got to say, most investors will say publicly, well, listen, AI is going to build productivity. It will be good for the job market. It'll get rid of the boring jobs that junior analysts do. It was kind of refreshing here to hear from a CEO that said, well, wait a minute, are we ignoring the risks that this could have to the broader job market? And he's really worried about kind of the social unrest that could really spur from that.
Yeah, absolutely fascinating stuff. I mean, when you think about the potential risks, it seems like the sky is the limit, right? But when you look at just the potential for these early stages of AI to help with productivity, I think a lot of the biggest CEOs from Jamie Dimon on down are embracing it as a tool for work.
Fair to say, though, that it hasn't been enough of a shakeout in terms of what the valuation should be reset to, whether we have flown above. I mean, he's doing those 1998 comparisons. We know plenty of people don't. I've got to say, though, Oaktree, for its own part, because they're a distressed debt investor, they're looking for what will happen once you start to see that shakeout.
Well, just look at the volatility you see in Lumen. I mean, we were just talking to the CEO. Today, the shares are down 12%. Last week on Tuesday, they were up 93% into the close. I mean, that's just absolutely insane. Let's take a look at the markets. We see swings in terms of the indexes, not nearly as big, obviously, but we are now up. We were up at the start of trade briefly, then we fell down about 0.25%. Now we're up about 1/3%. Really, I think NVIDIA is one of the biggest drivers here. NVIDIA shares are up 5%, and when that rises, you see gains on the S&P and the NASDAQ. If we were to look at the Dow Jones Industrial Average, and I'm not suggesting that we do that, you would see losses there. In terms of the groups that are moving, this is just today, and obviously IT is going to be the biggest gainer with NVIDIA in that index, but you also see energy rising as oil rises. We saw at least Brent crude eclipse $80 a barrel. Consumer discretionary is up, maybe on a little bit of optimism for the economy, but everything else is down, including communication services, which has the big sort of AI hyperscalers on it. So all of those other big mega cap tech stocks may be down today.
I was watching financials. The KBW Bank Index actually lessening its gains gains here off of session highs. So mixed market out there, Matt.
Yeah, absolutely. All right. Coming up, consumer spending still a key narrative for investors this week as we get the latest read on inflation, as well as results from retailers like Home Depot and Walmart. We'll lay it all out for you. This is Bloomberg. Investors waiting for a slew of data this week, which includes reports on U.S. consumer inflation, retail sales. Obviously, we'll get the producer look as well as the consumer look. Reports from some of the biggest retailers are also going to be front and center. We'll get the earnings from Home Depot, from Walmart, just to name a few. Here's a few more on the board for you. These results on top of the other data will help guide the Fed's September meeting. Let's discuss with Bloomberg economist Stuart Paul. Great to have you here on set with us, Stuart. What do you think? Is the Fed already locked into a 25 basis point cut? Because when we hear speakers like Mickey Bowman, it makes you question maybe your conviction.
So you'll hear speakers like Bowman say that nothing is predetermined. You'll hear folks on Wall Street saying that a 50 is still very much so on the table. We still do have a lot of data left to see. So does the Fed before we get to that September meeting. I think that the data that we're going to see this week is going to be a bit of a reminder that stagflation risk remains real, and buoyed inflation, buoyed prices through the end of the year could still be a problem that the Fed has to fight.
Well, explain a little bit more about where you might see that stagflation risk.
So I think that when we look at producer prices, just since they're coming up first, there's going to be a little bit of a worry around healthcare prices, health services in particular, with higher Medicare reimbursement rates. I think that we're also going to have to worry a little bit about portfolio management services, because those are coming from July when stock prices were still rising more consistently, and folks were turning to their investment advisors, and investment advisors were raising prices. Those are some of the factors that feed into core PCE inflation, which is what matters most for the Fed. So we're going to see some of the underlying factors, some of the line items within the two inflation reports that actually create upside risk for core PCE inflation, which is really what matters for the Fed.
You just did a fantastic look at swing state economies with Sean Donnan, I guess for Bloomberg Business Week, right? I mean, it looked really well done, laid out. It's scary how different those economies are than the economies that we think about here on the coast, right? How bad is inflation for people in Erie, Pennsylvania, for people in Nevada, for people in Georgia right now?
Nevada, Arizona, Georgia, all pretty rough when it comes to cumulative inflation over the past 4 years. In some states like Nevada, it's really showing up in home prices. For the home buyer, the median home buyer in 2016, 2017, 2018, they only had to devote about 17 to 20% of their monthly income to making mortgage payments. Now with both higher home prices and higher interest rates, that's up to about 30, 35%. Cumulative inflation is really taking its toll on those voters. Some of those states also have a very heavy manufacturing base. We're going to get some manufacturing data this week that's going to, I think, show manufacturing in decline through July, not the sort of thing that Kamala Harris is going to want to see before the election.
Here's the thing about home prices, too. Rates go down, prices can go up, but how meaningfully? That shelter component of inflation, where's the issue here? How does that really progress?
So back to the CPI item where shelter inflation is a hugely meaningful component. We saw a major step down in shelter inflation, in rents, in owners' equivalents of rents in the June data. We're expecting to see that rise just a touch, just to show a little bit more persistence in those underlying inflation pressures, because the supply of homes that are available is just so dismal. You have just a lack of supply buoying both home prices and rents going forward. And because of that, again, we just have this vector, this major chunk of inflation that just is not giving way and is making it more difficult to the Fed to just step in quickly, cut aggressively, even though markets are expecting about 100 basis points of cuts this year.
That last mile is the hardest mile to run. Stuart Paul, Bloomberg Economics, we thank you so very much. Of course, it's going to be a very busy week of economic data. Stick with us through it all. We will guide you through it. This is Bloomberg.
Let's get to the trading diary. This is what you need to be watching this week. We get the New York Fed 1 year out inflation expectations that coming out in just about 5 minutes time. So type ECO-GO on your Bloomberg terminal to follow. Tomorrow we get the PPI data that's at 8:30. The producer prices come in and give us an early look at inflation. We get earnings from Home Depot to see how the consumer is doing. On Wednesday, we get the consumer side of inflation. CPI comes out at 8:30 on Wednesday morning, and then another look at the consumer through the corporate lens after we get earnings from, or as we get earnings from Walmart as well as Deere.
I'm going to get a check on these markets now because there is divergence. You're watching the S&P 500 still on the rise now. It took a dip a little earlier in the session, now up about 0.4%. The NASDAQ 100 up 0.6%. Interestingly, though, the Russell 2000 still down almost 0.5%. The 2-year yield holding steady at 4.05. Remember, we have a big week of economic data ahead. That is what the catalyst will be.
Yeah, you know what? It's interesting. Everyone talks about the inflation numbers as the catalyst. But remember, last week we got a bad look at the consumer with TripAdvisor, with Airbnb, to some extent with Disney as well. So I think it's going to be really fascinating to see what we get from Home Depot, from Walmart, and separately on the Deere front. As Abigail was telling us, there's so much corn and soybean that those prices have come way down. It's going to be difficult for farmers to order new equipment.
Retail sales ahead as well. We're going to get a lot of looks into it on Open Interest this week, Matt. CEO of Tanger joining us for our C-suite interviews, followed by the CEO of Shark Ninja on Wednesday. Stick with us through it all. This is Bloomberg.